Hey, good afternoon, everyone. So my name is 𝐓𝐿, and I'm a research analyst at iFAST. So it's really a pleasure to see such a great turnout today and see so many of you interested in investments and interested in China. So just looking at my title, I think you probably can make a guess that where we stand today. So we think it's time to buy China. And if I told you that probably 1 or 2 years ago, you probably will be asking me like, are you sure? Do you see the headlines? And why are you so convinced? And given the China's market's hardships going through over the past few years, I'm sure that even as of today, many of you are still not very certain about why are we having such a conviction call today. So I stand here today and I wish I can give you a new perspective on why we believe that the China market worth a relook and worth a buy. So we know that China's economic hardships all started with its shift towards a centralized top-down economic models. And that follows with a wave of regulatory crackdowns that started with targeting with the tech companies. Then following that, it spread over to other industries such as like online gaming, educations. And then we know that there's a clear preference of the government towards the state-owned enterprises, while the private businesses, such as like the major tech companies, such as like Alibaba, they have came under intensified government scrutiny. And following that, we see a series of economic problems, such as like rising youth unemployment, sluggish consumer spending, then severe property meltdown. Then following that, we have escalating geopolitical tensions with the Western countries. And of course, if you see so many of the events and investors' confidence get eroded. And of course, we see the valuation of the market fall and capital start to outflow of China. And now we have to admit, as of today, many of the problems still exist in the economy. But we have begun to see that the story of China has started to shift. So if you just look at this chart, let's see the year-to-date returns of all the markets under our active coverage. You can see a pretty different story this year. So if you still remember last year, which is the developed market actually led the performance, we know that US is on the top. But if you look at this chart today, you can see that actually emerging markets are leading the performance this year. So you can see that China has gained around 9.3% returns year to date in SGD terms. And if you look at China Tech, has returned around 10.2% returns year to date in SGD terms. But if you're stripping out the effects of the weaker Hong Kong dollar this year, then you will know that actually these two indices has returned around 20% return year to date in local currencies. So that's very impressive, isn't it, compared to what we observed in last year or the year ago. So what has happened actually in the China market? So we believe that the true catalyst is that we believe that the structural risks in China are receding with the government now ramp up supports for the private sectors. So now we are seeing that the government has increased a lot of help for the private businesses for them to grow. And actually the tide started to change in 2023 when the regulatory crackdown has started to ease. And in 2024, actually majority of the major tech companies have seen their businesses return to normal operations. But we believe that back then, actually the policies were not strong and consistent enough for us to really mark it as a true turning point. So we believe that the true inflection point actually came in this year. So if you look at the table above, you can see that the policy momentum this year has been very consistent and accelerating. So just do a quick recap of what has happened this year. So in January, we see that the rise of DeepSeek really shocked the AI world. And its rise also reminds of the Chinese policymakers that in order for China to overcome the tech bottlenecks, it has to include the private sectors for them to drive the innovation in China. And in January, we see that following that, President Xi held a high-profile symposium with the leading entrepreneur tech leaders in China that includes long-absent Jack Ma. So that's a very powerful signal It shows that he now knows he needs to rebuild trust with the business community and to re-engage them in China's innovation. And in March, here comes the annual two sessions meeting. And we see that it unveils the plan to support the private sector by enhancing financial access for the private companies. And it also encouraged these private companies' participation in major infrastructures and AI development projects. And in May, here finally comes to the introductions of the Private Economy Promotion Law, which is the first law explicitly dedicated to supporting the private businesses. And this law aims to ensure fair competition, equal access, and provide the legal protection for the private businesses in China to grow in the years ahead. And we believe that in the following years, China's growth will be more balanced and more sustainable, that is powered not just by the stability and the skill of the state-owned enterprises, but also by the agility and innovation of the private businesses. So after seeing all these changes in this year, we have also decided to upgrade the investment rating in China from 2.5 stars neutral to 3.0 stars attractive. So why we believe that a revitalized private sector is so important? That's because we believe that a private sector expansion actually holds the key to economic growth. And let's zoom into one of China's most pressing challenges, which is about the labor market conditions. Or more specifically, you can talk is about youth unemployment. And we know that this issue came to the forefront since the regulatory crackdown back in 2020 and 2021. And by mid of 2023, the youth unemployment rate in China has already surged past 23%. And of course, it will affect household sentiments and drag down the consumptions. But we have seen that changing actually in this year. And we see that private businesses are the one actually leading in terms of job creations. So one of the most recent examples would be how Tencent has recently actually introduced its largest ever internship recruitment program that aims to recruit around 28,000 students over the next 3 years, and with a strong emphasis on full-time conversions. So this is not just a hiring campaign, it is a signal. It's a signal telling us that private businesses are extremely critical in absorbing Chinese growing number of educated youth pools in the future, and that will help a lot in terms of absorbing the unemployment rate in China. And next, we believe that a more stable and healthier labor market is also fundamental to China's shift towards a consumption-driven economy. So if you look at the graph here, you can see that actually retail sales has been growing at a much resilient pace compared to last year. So you can see that retail sales has exceeded 5% year-on-year growth since March. And of course, stimulus measures such as like consumption voucher definitely help with this. But we all know that this kind of efforts will have a fading effect. They are just temporary effort. So that's why we believe that a healthier, more stable market that anchored by private sector expansion will provide China the structural foundation to sustain its consumption momentum over the longer time. And then another area has been hit pretty hard over the past few years was investor sentiments and as well as investments. So if you look at a graph here, then you can see that actually the domestic private investments in fixed assets has grown at a near zero level since 2022. And foreign direct investments has dipped below zero since 2023. And during this period, we know that people are not very confident in China and because they are scared of the policy calibrations. But that has started to change last year, September. So you can see that foreign direct investment has actually made a reverse since last year, September. But if you look at domestic private investment, it actually still contracted throughout the second half of the year. And that just makes one thing clear to us, that is, stimulus alone is not enough. Investors are looking for long-term structural assurance so that they will have the confidence to invest back in China. So we believe that the first positive sign has already emerged in the first quarter. So if you look at the domestic private investment in fixed asset in the first quarter, it grew by around 0.4% year-on-year. Although this number is still very small and shows early stage data, but we believe that it aligned pretty well with the structural reforms that has been discussed above in my previous slides. And we believe that changing people's confidence and rebuilding trust is definitely a long-term process. It can't be done overnight. So with China's consistent implementation of structural policies and these reforms, investor confidence will gradually coming back to China with seeing a lot more stable policy implementations. And that, we believe that will provide a more sustainable and more credible pathway for China to achieve its 5% growth targets in the years ahead. And I think we have talked about a lot how these policies has transformed into bad economic data, but we have actually seen positive effects in the bottom lines of the company's earnings. So if you look at the MSCI China Index earnings, they have demonstrated a pretty strong rebound in the first quarter. And among all the sectors, you can see that information technology led the charge and grew by around 40%. And following that, we have communications, which grew by around 21%. And then following that, we can see that consumption-related sectors such as like consumer staples, consumer discretionary, they have also grown by around over double digits. And in the first quarter, we have also seen that companies that are deeply involved in AI developments and also in consumption, they have seen substantial revenue uplifts. So you see like companies like Alibaba, Tencent, and JD, they have seen substantial increases in marketing revenues, supported by AI-powered advertisement tools that help with targeting and conversions. And companies like Alibaba and also Baidu, they have seen also double-digit growth in earnings in terms of cloud revenues as AI demands workloads increases the demand for scalable infrastructures. But of course, we know that the soft tech segment in China is accelerating. The hard tech segment is somewhere that China is still lacking compared to the Western peers. So in that space, we know that US has tight control in its technology. So Chinese companies, they can't really access the advanced chips from NVIDIA, for example, models like A100 or H100. So a lot of companies, they have to source domestically for this kind of chips. So that's why a lot of domestic companies such as like Huawei's Ascend series, they have been developing pretty well and has been used in DeepSeek RM models. And Huawei's Kirin 9000 series. And also Xiaomi's recently launched the first ever Chinese-built SoC X-Ring01 has also been a very key commercial enablers, and they help with profit margin expansions and also have a better ecosystem controls. And we also saw this rapid accelerations of chip advancements in China. But we also acknowledge that the chip manufacturing is an area that China still lacks behind the Western peers because China doesn't have the access to the advanced EUV machines. So it has to rely on the older DUV machines for manufacturing its chips. And that will limit its manufacturing capabilities to 7 nanometers node and above, and also affects the foundries' profit margins. So companies like SMIC and Hua Hong, these companies, although they have seen an increase in demand for chips, but because of they have to constantly invest in R&D and in new equipment upgrades, so they can't really earn a lot of profit at this time. So that's why we believe that Chinese policy at this moment supporting these sectors are extremely important because they allow this company to grow at the expenses of short-term probabilities and allowing them have money and also resources to grow China's innovations and R&D. And thirdly, we have seen that consumption momentum is regaining tractions in China, and we can see that most recently concluded 618 mid-year shopping festival actually sells across various e-commerce platforms and also short video platforms has grown about 15% year-on-year compared to last year. And last year, remember, it was a contraction. So that's a huge improvement compared to last year's sentiments. And this year, we see categories, they are like home appliances and skincare products. They actually lead the sales figures. And those actually pointing to a recovering household sentiments and also this willingness to spend on discretionary products compared to last year. So I think I have talked a lot about how domestic policy tailwinds can support the growth of China's economy, but I think many of you definitely are still very worried about geopolitical tensions, like how China is going to stand like in terms of like the Trump's tariff. And that's extremely valid concerns. But here I want to give you another reason that why we are so confident in China and why China can remain resilient this time. So in general, companies in MSCI China generate around 15% of their revenue from the international market, and which is a lot smaller compared to a lot of the peers. If you look at MSCI EMX China, they actually generate around 29% of the revenue from international market. And if you look at Japan, which generate around 47% of their revenue from international market. So China's domestic focus naturally gives the companies a natural hedge against external headwinds. And if you look at the top 10 securities of the MSCI China Index, you can see that PDD actually is on the top of the list because it's North America-focused e-commerce platform Temu, which is contribute around 45% of the company's revenue. And because Temu's business model is heavily rely on price arbitrage and services fee, so that's why it is very vulnerable to tariff rate hikes and also the removal of the diminished rule. And second on the table, we have Xiaomi. So this company also generates around 42% of revenue from the international market. But different from PDD, Xiaomi's focus is mainly on emerging markets such as like ASEAN, such as LATAM, such as like Middle East. So it has a very limited exposure to the US market. And moving on down the list, we can see companies like we have discussed above that deeply involved in AI advancements and consumption such as like Alibaba and Tencent. And generally you can see that they generate around 10% or even less of that from international market, and that will give Chinese companies some hedge against external headwinds. So to summarize, why we believe it's a good time to buy into China. So first, we believe that with the policy recalibrations, so there are more support for the private businesses and there are even laws to protect it. So now the signs of policy credibility are gradually returning to the China market. And second, we believe that there are stronger backing for technology this time, and the government is actually tapping on the huge entrepreneurial systems which can drive China's innovation growth in the years ahead. And third, we have discussed about a lot of macroeconomic indicators such as retail sales, such as like better unemployment rate in China, and these factors are all pointing to actually a gradually warming domestic like household sentiments. And fourth, capital inflows finally returning, and although still at a small and early stage, but we believe that with China's consistent implementation of the policies, confidence from the investors will gradually coming back to China. And five, we have also discussed that Chinese companies can generally generate most of their revenues from domestic markets. So this will give them a natural hedge against external headwinds like tariffs in these years of time. So that's why we believe that 2025 will be a year that actually non-US market can shine, and China with its policy recalibration definitely will have seen a lot of momentums, a lot of growth drivers. And here we recommend investors to diversify your portfolio and increase a little bit allocation into China. So here we encourage you to invest via this ETF called iShares, called MSCI China ETF, which is listed on Hong Kong Stock Exchange with a code 2801. Or if you prefer the USD version, then you can also consider the one listed on NASDAQ which is called iShares MSCI China ETF, MCHI. So both ETF actually gives you a broad-based exposure to China, capturing large and mid-cap representations across Chinese companies, including both A-shares and H-shares. And if you look at the top 10 securities on this ETF, you can see that actually 9 out of the 10 securities have delivered like positive returns year to date. And also, we recommend the investors to consider China Tech ETF. So you can invest in China Tech via the iShares Hang Seng Tech ETF 3067. So it seeks to track the investment result of the index composite of the 30th largest, the biggest, and most influential tech companies that listed on Hong Kong Stock Exchange. But of course, if you prefer some SGD exposure, you can also consider the one that listed on SGX. It's called Lion OCBC Securities Hang Seng Tech ETF. And this one is denominated in SGD terms. But do take note that this ETF carries a slightly higher total expense ratio of 0.68% and has a slightly lower average liquidity compared to the one that listed on Hong Kong Stock Exchange. So with that, thank you so much today for joining me, and I hope you can all make smart moves and make great profits in the China market. Thank you so much.